And welcome everyone to Small Biz Matters, the half-hour program where you work on your business rather than in it. My name is Alexi Boyd, your trusted admin advisor, bookkeeper, lover of all things small biz. Welcome back to a new year here in 2018. Those of you who were listening last week, we had a fantastic show with a wonderful guest, our Michelle Archer, our regular employment lawyering, just made up a word, legal expert, came on to tell us all about entitlements and talking about how to accrue them, how to organise them for your staff, and what happens when, heaven forbid, a staff member doesn't come back after Christmas. So that was a great show. Make sure you have a listen to our podcast via the smallbizmatters.com.au website. Now today, equally an excellent guest once again, and I'm super excited today because this is a topic that befuddles, I think that's a good word, befuddles most small businesses when it comes to money. Now money. It's all we think about with small business. We're trying to make it, we're trying to break even, we're trying to think about cash flow, we're trying to think about our books, our receipts, everything else. It all kind of centres around money, which in a way is a bit sad because most of us started a small business so that we would have work-life balance, but that's okay. At the moment, lots of us are thinking about money, particularly with the economic climate that it's in. So how do you inject money into your business? How do you, say, for example, get a great big fantastic order for an overseas company and you need to produce stuff real quick, but you don't have the capital with which to produce it in order to fulfill the order? How do you gain some capital to set up a new office premises? That costs money too. A lot of the things that we do as small businesses need outlay and they need an initial capital injection. And it's not just about the big four banks anymore. These days, there's lots of options when it comes to getting money and applying for money. But like everything, you need to have your ducks lined up, you need to be organised, and you need to make sure that you're a pretty well-to-do, well, not well-to-do, but you're doing well in your business before you can start applying for any sort of decent sums of money. So here today we've got Declan. He's coming here from Valiant Finance, and they're a group who work with small businesses to essentially give advice when it comes to small business lending. And it's going to be a great show today because we're going to talk about a whole bunch of things around small business loans and lending, and in particular, the landscape. Because many of us, when we're thinking about loans or money or capital injections, we go, I just need to go to the big four banks and maybe one of them will give me some money. But it's actually a lot different from that now. And here to talk about us today is Declan.
And with that absolutely wonderful introduction, thank you, Lexi.
Thanks for coming on the show today, Declan. Now, we met a couple of weeks ago and I was totally impressed by the concept. I mean, I'm sure it's an age-old concept, mortgage broking or broking, but not that I've heard of in the form of small business. And more importantly, as well as being a business yourselves, you actually support small business as well through the New South Wales Small Business Commissioner's Office and work with businesses to give them the advice that they need on that basis, which is great. So thank you so much.
You're welcome.
And you've got events too, which is really great. We're going to talk about that a little bit later in the show. So let's talk about it from perspective of who is Valiant Finance. What is it that you provide? What services do you provide?
Let's see if we can unbefuddle the market. So Valiant itself, essentially, the best way to put it, it's an online loan marketplace. So it's a bit like Hotels Combined or Skyscanner. What we'll do is we'll compare the market. So we'll look at all the loans that are available to you in the market, and we'll try and pick the best one based on your circumstances. So how you trade, what sort of business you're running, how long you've been in business, how long you'd like to pay the money back in ideally, and then we'll try and find the right loan product for you.
Okay, so that's really awesome. And what ways does that come around for the Small Business Commissioner in giving that advice under that banner and underneath, the Business Connect program?
So Valiant itself is a commercial entity. We are a broker. And then based on the fact that because of basically what we do, the government or we tendered to the government to work as part of the Business Connect program. So you may have been on a few months ago, I think, when Matt from Realise Business was on. We are a little bit like Realise Business in that we are one of the advisors who works as part of Business Connect. However, Realise offers generalist business services, and then we also have a few other specialists as part of the program. So there's a digital marketing specialist, and then there's a creative industry specialist, and then Valiant's just joined as the newest specialist. We're the finance guys.
Awesome. And that's a pretty good package, isn't it, that the New South Wales government is offering people? And it's largely free. I mean, you can get, I think Matt was telling you can have up to 6 hours of free advice through Realise Business. And obviously with you guys, you're supporting small business through free advice around business loan products.
That's right. So the one correction I make there is you get 4 hours to spend in the program amongst any of the advisors one-on-one.
Oh, it's any of them. So thinking
Exactly
about whether
right.
you're creative or you need that digital
Exactly
marketing
right,
experience. Yeah.
So what I often find is when I get someone, so if someone fills out the application form online and they tick finance is their issue, they come directly to me. But then my job is also to try and work with them on the finance part, but then put them in touch with a local general advisor they can work with. So Matt would be a great example. I send a lot of people to Matt. They'll work on a business plan with him perhaps, and there might be some supporting documents that we need as part of a loan application. And so they'll work on that with a general advisor. And then they might also work on their digital presence with our digital advisor so that when we can make a loan application, we can show, well, this is how the money will be returned. This is how the repayments will be made. Yeah. So so like a bit of a package deal. And in the same way, Matt sends people to me when they're ready to borrow. And then we send them back to Matt to prepare on the
And that's where a lot of the confusion is, isn't it? It's what do you need to do to prepare? And that's a great service that the government's providing there, because it's kind of a package deal. Here, come to this Business Connect service. We'll get everything organised for you so it's ready to go, and then we'll give you the advice that you need so that you're seeking the right business loan product, for example, for your business. And
that's exactly right. And it doesn't matter what stage you're at. You might be thinking about starting a business and thinking, oh, well, is this going to work? I wouldn't mind someone just running their eye over my plans and seeing if it is going to, feasibly become a business. Alternatively, you could be a year in, you could be 6 months in and having a bit of trouble. You could be 4 or 5 years in and you're thinking, okay, well, I'm doing really well, but I'd like to do even better. What can I put in place to grow? And it's one of those things, you might be 4 or 5 years in and everything's ticking along well, but it never hurts to have someone have an outside perspective and say, well, hang on, have you thought of this? Or, this might be a way that we can save a bit of money on, your bookkeeping or your accounting. Should we try that and see, we'll free up a bit of cash for the next job.
If you can give me a bit of, give me some examples of businesses and what ideas that they might, why would they need a capital injection? I mean, obviously, you buy products to make to sell. That's an obvious one. But where are some more unusual reasons why people have decided to finance?
Some of the more interesting ones that I find, so the ones that I find quite cool and quite useful, and there's a statistic I read that said that 90, and please don't quote me on this, everyone, I read this a while ago, but 90...
We won't, you're only on radio.
Okay. So 90% of business owners out there don't want to grow. Their main concern is having more control over what they've already got. So I found that really interesting because I looked at some of the lending products that are coming out, and I think that's reflected in that. A lot of them, although I think some lenders though may have it a little bit skewed in that they always target businesses with with slogans like borrow some money to grow, capital injection to do the next job or whatever it is. Whereas the loan products I find quite interesting are ones like debtor finance or lines of credit where you can essentially borrow money up against your invoices or against, or maybe not as a full-off loan where you borrow the full amount in one hit. You might borrow 50 grand, say, over the course of a year, but you draw it down as 5 separate individual tranches of $10,000. So what I like is all the cash flow solutions. And so a good example would be, let's say you've got a tradesman or a subcontractor working on a big job site. Often they get paid according to payment terms where they might only get up to, say, 90% of what the job's worth until a certain date when it's agreed upon that they'll get paid the rest of the 10%. But in a lot of cases, that might be one of their bigger contracts for the month. So they're then stuck waiting on the payments to come into their account so that they can pay their own subcontractors on the site. So what they'll have is there are products out there which will allow them to basically, or will allow the business owner to borrow against those invoices if they're consistent and regular, and you can demonstrate that this is something that's going to come in a few months' time. You can borrow up against that. You might pay a very small amount on it for a short period of time, so say a month or 2 months while you wait for that payment to come in, and then you can make the payments to your own subcontractors and stuff. And so essentially it just stops that stress of not being able to pay your own employees because you're waiting on a big bill to come in, and then you can obviously pay your employees afterwards.
And do you find that that's a lot of businesses coming to you are talking about the cash flow issue?
Oh, absolutely. It's definitely the biggest one. The next biggest to that would be people looking to borrow to start up.
Oh, of course, yeah, because there's always startup costs unless you're just someone working and just needs a laptop, essentially,
exactly right,
with just services. So it's an interesting thought process there because The cash flow issue is something that I find quite frustrating, and I think I need to drag in Julian Leeser MP into here and get him to explain why it is that we allow big business to have end of a month plus 2 months turnaround when small business is pushed and expected to, and it is, you know, what is everyday work with money is basically to have a 14-day turnaround. So why have we got such a disconnect between what big business does and what small business does? Because the trickle-down effect is exactly this. You've got people needing to borrow money in order to fill those gaps. Would you think that, with your knowledge of the finance industry in this regard and small business and what their needs are, would you like to see Australia move to a system of a 14-day a compulsory 14-day turnaround for payment terms?
I think...
Because they do that in France. There's a number of European countries that have an enforced X number of days invoice payment, and then you are entitled to start charging interest.
I think for a lot of the smaller punters out there, that would be fantastic. So especially, and I'll use the jobs, you know, the work site example again, because it's quite a common one. But a lot of those guys are... And there are certain legislation out there that actually helps, you know, guarantees their payment on time. But, like you said, is that what really happens a lot of the time? The other example would be a lot of people who supply Coles and Woolworths, for example, like you said, they get paid on like a 3-month term. And then, that's what they're meant to be paid on. But then it might even be stretched out to a 4-month term. So you can imagine being the farmer who supplies oranges or mandarins to Coles and having 4 months worth, 4 months where you don't get paid, but you've also got workers on site who you need to pay as well. So I think, would I like to see it go towards that? I'd certainly like to, as a big advocate of smaller businesses, I'd really like to see something like that. Maybe not enforced. I'm not sure how effective that would be. Maybe with some of the bigger guys, I can understand why they operate the way they do.
Oh, it's just to make money. It's just to hold on to the money and make interest. I mean,
exactly.
that's what's so appalling about it, and it gets me so frustrated on behalf of small businesses that if they weren't doing that, then the trickle-down effect, it just literally accelerates the economy.
And it doesn't
overnight.
exactly, it doesn't exactly incentivize you to start a small business when you know that that's the way you're going to be treated by the bigger players. And
the number one reason people are trying to find out information is all about cash flow and productivity, and therefore that's why, do you think that's why we've got a changing landscape? Which brings me around to our next topic of discussion, which is how much have things changed in, say, the last 10 or 15 years? Literally, I've still got the mindset, whereas if I think about money, I go, yep, head to your local bank. But it's not like that anymore, is it?
Absolutely not. And I think that is a perfect way to lead into this part. The big thing that I've noticed is how technology is playing this huge role in how it's changing. So, like you said, the whole whether we could get it down to a 15-day turnaround on the terms and things. I think things like Xero, Intuit, QuickBooks, they're helping. So MyOb as well. Those are the sort of things where if more people were on them and were organised with what they had on there, then the whole process would be a lot slicker. And like you said, it's not necessarily just about the banks these days. One of the big principles of lending, or one of the things that I guess the basic principle of lending, right, is that money in your pocket today is worth more than money at some point in the future, because I can do something with the money today to earn a return on my investment. So the problem with, I guess the thing that you'll find with the banks is banks have a very certain, there's a lot of criteria around banks on how they can lend money, which is actually a very good thing for all of us, because if you think about it, at the end of the day, the bank's money is my money and your money and everyone else's money. So it's important that there's a lot of regulation around how they can lend that money out, and it has to be done very safely. So in order to borrow from a bank, there's 3 things that you'll need. You'll need to have security. Very, very commonly, or pretty much always, in the form of a residential house. That's
what. Just can I just stop you there, because I'm curious about that, because obviously when you're a sole trader, you are the business. It's in your name. The income is in your name, and the house is in your name. So that's all intrinsically linked. If you're a PTY Ltd, which many small businesses are, when realistically they're not big companies, can they still use that residential property as if it's in their name because they're the director?
You can.
Right. Okay.
So it comes down to, a lot of the time, it will come down to, like you said, the directorship. So in order to use the housing, in order for, say, for myself to use a house as security, if I was PTY Ltd company, I'd need to be a listed director with a vested interest in the company. And
a listed owner of the home.
Exactly.
Okay, gotcha.
Yeah.
I just want some clarity there, because I wasn't sure where the link was when it came to loan.
But you are right. It's like you said, though, in the case of a sole trader versus a PTY Ltd company, lenders will look at them differently, because they're different entities. Whereas with the director, there's the liability that goes with that, versus if you're a sole trader, you have more liability.
That's right. Yeah.
So it's just I guess it's arm's length versus a little bit closer to home.
Okay, so we've moved away from the big four banks now, and now we're looking at sort of more lenders out there. What type of lenders are there specifically? We've got the four big four banks.
The big change, I'd say, and you're talking over the sort of the last 3-5 years, is the rise of what they call fintech companies, which is just an amalgamation of the word financial and technology. So Valiant is an example of a fintech company, but we don't necessarily lend. We just point you in the right direction. A lot of the lenders, however, they do lend. So because business lending is not subject to a lot of the criteria that personal lending is, it means that some of the stuff can be automated. So if you're going for a mortgage and you need to put your personal name on the application, if anyone's done that out there listening, you'll know that you went through some of the stuff about your living expenses to basically show that at the end of the month you'd have enough money to make a repayment and then some. So maybe to the tune of double the amount of money has to be left for you to cover the repayment. Whereas with business loans as well, the same thing obviously exists, but it's just less strict. So
when you say less strict, you mean it's less likely to be double the amount that you need to be able to pay back, or the criteria,
that's right,
the amount of capital behind you that you need?
It's less likely that they'll look into specifically how every dollar will be spent. So with the mortgage, they'll look into, they've got all sorts of calculations based on averages of how much it would cost to raise a child in Sydney. So if you've got one child, they'll account for a certain amount of your income going towards that.
Oh, it's so investigative. It's so just yeah. But it's not the same for business. They're not going to go, okay, how much rent do you have to pay for business? How much do you have for the repayments of blah?
So some of them might be a little bit more. They might look a little bit more into the serviceability of how will you pay it back. The real big difference comes down to the fact that banks operate under certain criteria that says you may not lend money in this way, and in order to do so, you'll need to take security, you'll need to prove serviceability, and the person you're lending money to needs to be of a certain character, which pretty much comes down to, do you have the right? Is your credit file looking good?
Yeah. Have you not been bankrupt? Have you not got a criminal record?
Have you got defaults in there?
Yep.
And all sorts of things. So that'll be what disqualifies you from borrowing from a bank. Whereas with fintech companies, they're not operating as a bank. So to have the name bank and to operate as a bank means you conform to the APRA regulation. Whereas if you're a lender like a Moolah or a Prosper, for example, you work you're a lending institution specifically. So you borrow money. A lot of the time their money comes from another fund, so they might borrow money at, say, 3 to 5%, and then they need to lend it out at 15 or so percent in order to make their own return. So then that's how they're living off the margin in between.
Right.
So,
but when you say they don't have the same criteria to meet, that means that they're not going to be looking at as forensically as banks do in order to have the loans?
But what it more means is that some of them, they won't necessarily need security for the deal, so they can do an unsecured loan.
Do they take bigger risks?
Exactly right. So the best way to put it is they'll take a bit more of a risk. So for them, but then a lot of them, because there's so many of them, what they've done is a lot of them will typically just take like one or two of the products that the banks were doing. So if the banks decide that they're not going to do an overdraft anymore, then there'll be people who come in and they try and do like an overdraft or a line of credit. So and what it will come down to is then they might say, okay, well, we'll lend this money to you without needing residential housing security, but we're going to really drill down into how you're going to pay us back, and what's your income been like for the last 2 years? How can you show that it's going to stay like that for the next 2 years, kind of thing? So, or what they might do is, on the other side of the foot, they might decide, well, okay, if you can give us security and show us that you can service the loan, but you don't have the best. You don't have the best credit file. Okay, well, we'll consider you guys. So that'll be that company's niche.
Yeah. Okay. So every company sort of behaves a little bit differently with the way that they approach the loan, as well as the products that they offer.
And they're all a little bit different to banks. They don't all have a huge amount of products. Like banks will try and do everything, whereas a lot of the smaller lenders are like, well, this is our niche, and we're going to stick to that. So the best example, there's a great example of a company called GoGetter. So they basically do like a rent to buy situation. So if you let's say you were a truck driver and you needed a new truck, you go along to GoGetter. You don't necessarily need to have a huge deposit or anything, and put up your house as security. So you might borrow. Let's say a common example that I've done quite a few of is you get a truck driver who's been offered the chance to go from employed to self-employed and being a contractor. So what they'll do is often they can make quite a bit more money for themselves doing that, and they really want to, but they don't have
the truck. Yeah,
they don't have the truck is the big spanner in the works. So what they'll do, rather than trying to save 30 grand or so going along buying a truck and then paying off the remaining 70% or 70K that a $100,000 truck would cost. You go to Go-Getter, you pay a month's bond, and then you basically start paying a weekly rental, which is slightly higher than you'd pay if you were to go and buy a truck out, normally and finance it normally. But it means that you can get started today, and so your income goes up considerably. You use the extra that you were in there to pay off like a weekly rental, and then off you go. And then in a year's time, you've got the option to either give them back the keys and that's it, walk away, or alternatively, they'll drop the rent that you've been paying. You do that for another 2 years, I think it is, and then once you've finished, the truck's yours.
Is that the old radio rentals kind of way?
Radio rentals kind of model. And what it does for your business owner is it says, well, you've got the option to basically earn a lot more, and if you work the numbers out, what it means is that rather than them having to wait and then eventually do it one day, it means you can get started now.
Yeah.
And then the percentage that you're actually paying becomes a lot less because you're earning a lot more.
And if we turn that around and think of that in a way that we all understand in terms of home loan, that just doesn't happen. There's no way that the bank's going to give you 100% and go, you've always got to have that deposit. So I guess in a way that's a different kind of product that's available.
Exactly.
Now we're just going to take a quick short break here on Small Biz Matters. You are listening to myself, Alexi Boyd from Small Biz Matters. And of course we've got Declan coming in from Valiant Finance. We're talking all about small business loans, money, capital raising, all that sort of stuff. You're listening to Triple H 100.1 FM. We'll be back after this. So just before the break we were talking about the way that the business lending landscape has changed in the last even just 5 to 7 years, that it's not just about the big four banks anymore, that we're moving across to different types of lenders who require different types of criteria. And I think a lot of our listeners today will be sole traders who are thinking about maybe becoming a PTY Ltd, looking at taking it to the next level and increasing their business, I guess, cash flow, because that's our major reason. And you were mentioning that a lot of those models are not just necessarily about show us that you've got a house, show us that you can service the loan and we'll give you X amount of dollars. It's kind of changed in that way. There's a lot more flexibility, would you say?
Mm-hmm. And certainly that would be true for people who haven't necessarily been trading for 2 years. So typically that was probably the biggest, the most underserviced market that would, for small businesses in particular for borrowing.
But isn't that the majority of small businesses?
Exactly right.
Trading for under 2 years?
And it's also the most dangerous time for a small business because I think, again, the stats, I'm hopeless with the exact numbers, but 80% or so of businesses that go under within the first year.
Yeah.
And I think a lot of that comes down to the fact that, and even then, a lot of the time, it's not a business that's not trading, not making a profit or profitable. It's just that when it comes time for them to make payments, they don't have the money in the account when they need it.
Yeah.
So again, like you said, it's a cash flow issue. The cool thing is there are some new different types of models to raise capital that I think are very cool for new businesses. One of the things that we do quite a lot of applications for is what's called peer-to-business lending. So it's quite a cool mix between, the way I describe it, it's a little bit like a mix between crowdfunding and borrowing money. So there's a few different ways that they run it, but essentially a lot of peer-to-business funders will have like an online platform. It might even be an app or something. And then what they'll do is they'll basically advertise to a huge audience of people who want to make investments in businesses. And they'll do a little bit of a bio on the borrower. They'll gather a bit about their experience. And the typical criteria for this is you're going to need absolute minimum. You're going to need 30% as a deposit. So let's do an example actually. So let's do the example of a cafe. So if you were a cafe owner, or say you've been working as a manager in a cafe for the last 5-10 years, so you've got some really good experience running a successful cafe. That's the first thing that peer-to-business funders will look for, is experience within the industry that you're going into. The next thing they'll want to see is a minimum 30% deposit, like I was saying before. So in the case of, let's say that you needed to borrow $100,000 to start a new cafe, the money will be spent on let's say a fit out for the new cafe. So you're going to buy some new equipment, do a bit of a fit out. You want a little bit on hand just to have as working capital for the first 6 months, and to pay some wages and things. And that's what you determine that you need. So the first thing that we're going to need is a 30% deposit to basically, it's what the lenders would call skin in the game. So essentially it shows I'm really serious about this. And I've put a lot of effort in, and this is my own stake in making these repayments. So then rather than you borrowing the full 100,000, you've saved 30%, and now you need to borrow the last 70%. So you still need to borrow 70,000. They'll do a bit of a biography on you, so they'll be looking at your experience. They'll also be taking a very they'll take a magnifying glass basically to your business plan. So they'll want to see cash flow projections for the first, ideally, year, 2 years. They'll also want to see a really, really solid business plan, and they might even ask for, depending on, they might even ask for that to be specifically from an accountant. Then what they'll do is they'll put all that together. They list that basically as a listing on their website, so all of their own investors can go in there and pledge a certain amount of money. So typically you're looking at about 18% or so that they start at. And so there's one lender in particular, what they'll do, so they'll put it on there at 18%. So then let's say that I'm scrolling through and I decide, actually, we've got a cafe owner here who's worked as a cafe owner for 5-10 years. They're borrowing $70,000. They've got a great location. Okay, cool. This seems like a no-brainer. I'll invest in this person. So you might put in $1,000 and you get a return of 18% on that investment. But let's say though that the listing is up there for a day, and then by the end of the day, it's filled up and everyone wants to invest. What they do is they'll drop the interest rate to say 16%, and then the bidding starts again.
Oh, so you can prove yourself to be highly experienced. Clearly, I know what I'm doing. I've got I've got all the financials in place. I know what I'm going to be spending it on. I've got a business plan, blah, blah, blah.
I'm good to go.
Yeah.
So essentially, the more popular your ad is on the site, the more people will invest, and therefore the lower the rate will be.
Can I ask a question? Are those companies that have that model, are they based in Australia? Are you getting Australian dollars? Yeah.
So the one of them is, the most famous one is called RateSetter. I really love RateSetter. In fact, I invest in people on RateSetter all the time. They're in Martin Place. So I think a lot of the time, and again, don't quote me on this, I think RateSetter is an American company initially, but they've got an Australian arm. And then there's a couple of others. There's two in particular that we send quite a lot to. Again, both Australian. Both Australian. Yeah,
I'm just curious as to know, with that those capital injections, obviously when you go to the big four banks, I suppose you never really know who's loaning you money, because there's international investment in those corporates as well. So I'm just curious to know whether the money is kind of coming from Australia and investing in Australian businesses, but it doesn't matter.
It's hard to say, because a lot of them will raise capital in multiple ways. So they might have an initial investment where they're funded by a venture capital company, and they're getting the money out, but then they might be 10, 15 years in, and they're at a stage where they can borrow money on an international scale. Like you said, they can borrow a huge amount of money on the free market and then lend it out in Australia. Hard to say.
So with the reason why I guess a lot of businesses just go straight to the big four banks is because they have confidence and they have trust in that enterprise. Is it kind of, my brain keeps coming back to those dodgy tertiary institutions that were giving people laptops and putting them on $30,000. I'm sorry, I don't know why I keep on thinking of that whenever I think of finance at the moment. But is there an element of dodginess to this? Because you mentioned before it's not as heavily regulated as banks are when it comes to their small business lending. Is there risk that you take on if you engage in a financial contract with these other type of lenders? Are you taking on any risk in that way?
Well, there's always going to be a bit of risk when you're borrowing money. So that's why I think the most important thing is to understand specifically what am I borrowing and what are the conditions on that. And I think one of the reasons that you might run into trouble with something like that is because people get to the point where they're sort of desperate with it, right?
Yeah.
So what I always encourage people is let's not only work out what you need to borrow today, let's work out what you're going to be borrowing in 6 months' time, in
so
a year's
time,
in 5 years' time,
yeah.
just so that you can plan for it. Because what you don't want is a situation where you do end up in a facility that it does have quite a high interest loan, or interest rate on it, and then things start, big orders that you were counting on don't come in, and just life happens, right? So you don't want to be in a situation where you are then stuck in that. You want to have a really clear, this is what I'm borrowing, this is when I need it returned by, and this is the specific schedule that's going to make that happen.
And all the more reason to really have a really good understanding, hence go and seek some advice through Business Connect and yourselves to find out what it is that those products are.
I would say that's definitely key.
Don't sign anything without researching.
Yeah, don't sign anything.
Because you're just so grateful, I guess, people are giving you money. You think, oh, good, okay, now I can do the things that I wanted to do.
And as well, you can see, you can sort of, and a lot of the business owners listening, you've probably had this happen to them before, but let's use another example, another tradesman example. If you've got a job coming up in February, it's December, Christmas is coming up, you're going away with the family. Okay, well, I'll think about it when I get back in town. Straight onto the tools. You're on the site. You're working away, and then all of a sudden you have that realization. Oh, actually, I better get that money ready for February. We've got a job coming up, and then it just sort of nothing. Things keep happening again. You keep getting pulled away all over the job site. Something goes wrong on the site. You got to go fix it, and then all of a sudden you're like, oh, hang on. and then you finally get around to sitting down and actually looking for the money online, and then all of a sudden you're now operating in a market where there's 10 plus pages on Google with real companies who will actually lend you money.
Yeah.
So it's not like normal, you do a normal Google search and typically you get the first two are kind of the real searches and the rest of it's just rubbish, right?
Yeah.
Whereas if you were to Google business loans in Australia, I've done it. You can go to page 15 or so, and there's still small unsecured lenders who are really keen to lend you money.
Right.
The reason is that, like you said, I mean, is there dodginess in it? I don't believe on the whole that lenders are dodgy. In fact, a lot of the lenders that we work with specifically, or that I know, are actually very collaborative. So if they can't help out someone, they'll send them to me, and then I'll try and redirect them the right way.
Yeah, that's good.
So yeah, so I'm confident in saying that there are people doing, the majority of the people out there are doing the right thing, but you've always got to sort of be careful with things like that. But yeah, I think just in general, I think it's getting better for the punter out there because the more options there are, it's a good thing. It means that there's more competition amongst the lenders. So rather than them having all the control, whereas banks might have had a bit more control over the lending environment before, more and more as there's more competition, it means that each of them has to compete to win the business. So better rates for the punter.
Yeah, and that works out for a better sort of level playing field. Look, we're going to take another short break now and listen to some more community service announcements. And when we return, we're going to be talking about what the lenders are looking at in terms of what financials you need to have in place, what reporting mechanisms, and how to go about getting those. You're listening to Triple H 100.1 FM. We'll be back after this. We're going to talk a bit more about small business finance, and particularly I want to talk about what ducks do people have to have lined up in order to go and speak to someone such as yourself. Because I can imagine you've got a lot of people coming going, I need money. And you're kind of, okay, go away and do this, this and this. What are those this and this that they should have in place?
Well, first of all, happy to speak to anyone who, if you're not sure what you need or anything, I'm absolutely happy to be a first call. What I'd say, well, typically a lot of the time it sort of comes down to, if you think about what am I trying to borrow, and then if I need a reason.
You need a reason for borrowing that money.
There should always be a reason. So there should always be some purpose, but that doesn't mean you necessarily have to have an exact purpose. So, for instance, if you were borrowing money, and let's say you were borrowing $20,000, $10,000 was spent on wages and $5,000 on the Christmas party and $5,000 on some various just office expenses, right? That we could classify as a working capital loan.
Okay.
So you don't necessarily need to have an exact, I'm going to spend every single dollar, doesn't need to be accounted for specifically, but there does need to be an outline as to what it's for, and it does need to be for a business purpose. So you can't borrow money to pay off a personal loan, or unless that's a personal loan that's part of your business. But yeah, it does need to be a business purpose, and you need to be a business entity that's borrowing.
And what are the guys who are loaning money, the lenders, what are they looking for in terms of data and financials? So
each will be a bit different depending on their own credit criteria, but then also dependent on the type of lending they're doing. So for instance, if we were doing a working capital loan, it's probably a great example, but what people will want, so I always say just sort of put yourself in the shoes of the lender. So if someone asks you for $10,000, what are the few things that you'd want to know? You want to know, right, well, I'll give you $10,000, but first of all, what happens if this goes wrong, or if you lose the money? How do I know that I'm going to get my $10,000 back? The second thing you want to know is, do you have the money, and can you show me that you're earning enough money in order to pay me back $1,000 every month for the next 10 months to pay me back the $10,000? And then the last thing you're going to want is, do I trust you? So if you put that into an unsecured working capital loan situation, because you're taking away the security element of the deal, in other words, you're taking away the what do I get if everything goes wrong, what you're going to focus on if you're the one lending the money is really, really demonstrate to me how you've historically made X amount of money per month and how much of that is left in order to make a repayment for this loan. So in that case, what they'll be looking at is they're going to want to see your profit and loss. They'll ideally want to look at your bank statements just to see that there's always a certain level of cash in the bank. And you're not going into overdraft every 5 minutes? Exactly, and you're not going into overdraft. At the end of the month, you're at the very last legs of your overdraft, and then you get paid a little bit there, here and there. They're going to want to see, maybe they might want to look at your debtors ledger. So if you are trading on invoice, are all of your invoices coming from one person? Are they coming from a multitude of different places? And there's quite a lot of variety in there. And how long does it take people to pay you back? Exactly. Are your terms quite good? Are you getting the money in the door when you're expecting it, or are you waiting on things 10, 15 days, 100 days even? So how efficient are you at bringing the money in that's owed to you? But also they'll look at just the general asset and liability summary for the company. So that, if you were borrowing for, let's say, for an equipment loan, they might look at your assets and liabilities. So how much money do you have currently going out the door? How much is coming in? So we'll heavily focus on the revenue. And there's a few sort of general rules that I'd always say. So let's say that you're borrowing $100,000 or you'd like to borrow $100,000 unsecured for a short period of time. You're going to spend that money to buy some stuff from overseas. And then once you get it here in Australia, you can sell it and then obviously make the repayments. So what they'll look at is they'll say, right, if you want to borrow $100,000, but there's no house for us to take and sell if everything goes wrong, what we're going to want to see is that you're turning over about $100,000 minimum every month. But that's just a general rule. I mean, if you're turning over $100,000 a month, but your expenses are very, very low, then you'll have a better borrowing capacity than someone who's turning over $1 million a year, $1 million a month, but most of that money is being spent, outgoings, right? So it all sort of balances out. But a rough rule of thumb would be you can borrow about 80% of your average monthly turnover if it's unsecured.
Okay.
That's sort of an average that I use when I'm doing calculations and things. If I hear that someone's turning over $1 million a year, divide that by 12. Okay, cool. We're looking at about this much unsecured.
So someone who is starting out for the first little bit, they're not going to have any of these documents in place. They're not going to have a history. Are they looking at a different type of loan, maybe with different conditions?
So the way that, and it still ties into how the lenders will look at it. So if a lender's looking at, if you want to borrow an unsecured short-term cash flow product and just borrow some money and then pay it back over 6 months, say, you're going to really have to show historically, this is what we've done. So if you're 18 months into the business, then some of them will look at 6 months of trading history or the 18 months of trading history and say, okay, look, we're pretty satisfied with this and that there's an ongoing trend towards this, not only maintaining, but going up. So there's a few things that you sort of want to demonstrate to them. One is consistency. So if you've got a monthly turnover that averages out quite well over the year, but the absolute majority of what you earn came in the months of January to March, then you're going to have a hard time showing a lender, well, give me a year-long facility and I'm going to make a repayment of say $5,000 a month or whatever it works out to be. But then there's 3 months of the year where that's going to be well doable for you, but then the rest of the year you're going to struggle to make the repayments. Like they're not going to want to lend that to you, because so ideally what you'd have is nice consistent turnover. If you can demonstrate to them, I bring in $50,000 a month, and that's happened routinely from the same clients from the last 10 years, then you're absolutely not going to have any. It's quite a safe bet, right? Yeah. Whereas the opposite, like you said, if it's someone who doesn't have a historical trading data to look at, what they heavily focus then is they'll take, rather than a historic viewpoint, they'll take a future viewpoint of the deal. So
knowing what contracts you've got in place and what clients you're expecting.
Exactly right. So the example I'll often hear, what we get quite a lot of is people they've got an idea for a business and they're trying to borrow quite a large sum of money, but the problem is we can't demonstrate to any lender, well, this is how it's going to be paid back because this is what the company's done so far, because the company's not done anything. So in that case, exactly like you said, if the amount weighs up to the experience of the new director, they've obviously saved and put a deposit together, and let's say they've already found 2 or 3 contracts that are quite extensive. So say one of the really common ones I'll get is someone who's got a new product and they want to sell it to like a food product or a new, food product's probably the most common one, or a clothing line or something, and they're trying to get it distributed. But then they're trying to basically make an application for, say, $50,000 or so, but there's no way to prove that there's any revenue coming in the future, right? So instantly, there's no one who will lend to you in that case because, and it comes back to your question before, like, is there sharks out there? There is, but I mean, I wouldn't say there's sharks out there technically, but like,
if you're high risk, then they're going to be high risk.
Exactly. No one's going to lend money to you in a situation like that, because essentially, even if you've got all the security in the world, then all they've done is really just taken your house off you, right? So none of them want to do that either. Like, they all have a good reputation. They're all aware of their own reputation as well. So a lot of them won't, they don't want to touch a deal if it's going to end up with them having to repossess someone's house.
Yeah, and then look crappy online because people are leaving all these horrible Google reviews. And the next thing, Tracy Grimshaw will be chasing them down the road with a mic saying, what's going on. So all of them are aware of that, and that's why as well. So I think lenders do cop a fair bit because you can understand why, right? So if you're the average business owner and you've got you might have left it a little bit late, or
you've been denied a few times, and you sort of were relying on one lender to come through, and then you got it denied at the last minute, and now you've got a job coming up and you really need the money for it, and people are saying no to you. It's easy to sort of think, well, these guys aren't helping me, but if on the other side of the coin, the lenders don't want to be the ones who are.
Yeah, they've got a certain
exactly
reputation
right.
that they need to uphold as well.
Reputation, but as well, they don't want to lend you money and then come back in a month's time and, you're now in more debt than you were before, and you're not keeping up with any of it. There is an element sometimes where you've got to say to someone, look, I think you're probably not in a position to borrow any more money.
Go away and start trading for a while.
Exactly right. Go get some contracts in, show us that this is a great product and people want it. And then we can look at, turning up the heat a bit. So.
And I guess that's why it's a really good idea to go through a broker of sorts, because you're not going out there and making any applications because, if you're just a chump off the street and you're just going and Googling it and you're making all these applications and you're getting rejected, that's going to affect your credit rating. Whereas if you go to a broker who knows the lay of the land and goes, well, nobody's going to lend you money in their right mind, don't even apply, go away and start trading for however long before you've got some financials in place. And I think that's obviously a better way to go.
Much better outcome,
much lower risk in terms of your credit rating as well. And I like what you were saying as well about the financials being in place and having records. I love record keeping. Yeah. I'm a fan. Yeah. So make sure that if you haven't already, that you've got some way of tracking. Now, it doesn't need to be a fandangled, expensive online piece of software, but it does need to be something. So it can be Excel spreadsheets that your accountant, whoever, can interpret and give some forward planning and give you some advice on. So you need to have something. You can't just trade with no data whatsoever. And as well,
and I guess as well, having the expectation to when you are working with a lender or with a broker, I guess realizing that if there's one or two things that you haven't maybe got up to date or ready to go, know obviously that it's something that will count against you, but just be ready with them. Like I do speak to a lot of people who will say like, oh, I haven't done this or I haven't done that for a couple of years or so, but I need to borrow X. Well, in order to do that, we're going to have to show them we're going to show them that you're able to basically borrow this amount and pay it back and be diligent with that.
Yeah.
But it's hard to make that case if you haven't done your taxes in 3 years kind of thing.
Exactly. So make sure your taxes and your BASs are up to date, because the biggest debtor quite often with small business is the ATO. Just keep on top of that. Look, we're going to wrap up today. Thank you very, very much for coming on the show. Now, how can people find out more information about what Valiant Finance does for small business?
You can jump on the website. You can, if you go to the Business Connect website as well, I'd direct you to. Anyone who wants to chat finance. One of the things that we haven't touched on at all, though, part of Business Connect as well, is we won't necessarily just look at debt finance. So debt finance would be any sort of loan product, so banks, private lenders, peer-to-business lenders. We can also help out if you've got a new business venture and you are looking at angel investment or venture capital raising.
Yeah, well, that's a whole new program. I reckon we're going to have you back on the show in a little while to talk about that, because that is an entirely different kettle of fish.
That would be an interesting one.
Yeah.
The other ones is, as part of Business Connect, we really want to connect you if we can with the Jobs for New South Wales products that they've got now. They've got some really cool ones. They've even got an equity product coming out, which is unreal. And also that, as part of that, if you're an Aboriginal business out there, we can help you out with the IBA. But there's a lot of options out there. So I'd suggest if you are looking, jump on the Business Connect website, fill out the form, and just tick the access to finance part, and you'll come through to me anyway. Yeah, and you can just have some advice there, which is awesome. And just tell us again about the event we've got happening on Monday, the 22nd of Jan. Yep. So there's how to access funding. The Monday one is in. Hope I'm getting this right, Lexi, but it's in Hornsby. I believe it's at the Hornsby Library. Hornsby Library. And then the Tuesday one will be at St Leonard's at the office of the guys from Realise Business. So we'll have a general advisor on hand as well. So if you've got some questions about anything really, cash flow projections, business planning, if you're maybe at a point where you're trying to sell the business or something, come along. There'll be some chat about finance. The guys there, Matthew and Louise Lai, they'll both be there. So we'll have a bit of chat on some general stuff, so you've got people around if you need it. The other one is we're doing another one on, there's one going to be in town on Wednesday the 31st. That will be at the office of a company called Tax Assure, who, funnily enough, was saying the biggest debtor is the ATO. These guys are absolute absolutely doing some great work with the ATO. If you are in any sort of tax set as well and you're a business owner out there, I feel like I should just say, give me a ring about that, because there might be something that we can talk to them about, and maybe, reduce some of the interest component, or borrow, from another institution to pay that out to ease up the
debt, the burden.
The red letters and things in the mail, if you're at that point.
Once I get to red.
Yeah.
Look, I have to say thank you very much for coming on the program today. We've covered heaps. There's so much more to talk about as well. And of course, out there, listeners, if you've got a subject that you'd like us to investigate, find out more information, let us know via our Facebook page, Small Biz Matters Australia. And of course, make sure you sign up to our newsletter at smallbizmatters.com.au so you can find out what's happening with all the events that are coming up on the calendar, because the calendar is starting to fill up again and there's lots going on. So there's no excuse for great networking, great education and great small business advocacy. So thanks again for coming on the show.
Thank you so much for having me. And
we will see you all next week with another great guest on Small Biz Matters, the half-hour program where you work on your business rather than in it. This is Triple H 100.1 FM.